Okay, and let's kick this off. 11 o'clock sharp. First of all, welcome everybody to FX Street. Hello, Maud. Hello, moderators. Nikki, Alinda. Good to see a bunch of familiar faces in the room again. And this seminar, or this webinar, for those of you that don't know me yet, I like to do things in kind of a lecture series. I think that, kind of talking out loud and thinking out loud is one of the best ways for an inexperienced trader to learn from an experienced trader. And a lot of my personal clients, they appreciate just sitting around and listening to my thought process. And I think that's a great way to learn. So I like to keep my webinars kind of informal. For those of you that don't know me yet, I tend to not talk about very specific ideas of what to do, but just general market concepts. And it's funny because I got an offer from a very large hedge fund this week, and the hedge fund world is a really strange place. This particular hedge fund was a quant fund. And for those of you that don't know what quant is, it's quantitative computer algorithmic trading. And, they were talking to me about my system. They said, we want to learn your system. And, we want to computerize it and make it better. And I said, okay, well, that's great. But I have 15 different ways that I trade, right? And they say, oh, 15 different ways to trade, that's interesting. We want to take your signal and, automate your signal so that the computer does your signal. And I said, well, I have various signals. And they said, oh, okay, well, this is really interesting. I said, well, can the computer think and, make a decision based upon what it's seeing in the market at any given moment in time? And they said, yeah, we can probably do that. So not to belabor the point, but the point I'm trying to make is that, what do the big boys do? Right? And by the way, when the big boys, they cheat, yes, they do. I'll get to questions in a bit, Fernando. The big boys, they code things up, high frequency trading, and large institutions, they think very, very logically about the market. And when you think logically about the market, it's kind of cool because when you understand what they're doing, and believe me, this is $1 billion fund, by the way. Okay, it's $1 billion fund. When you think logically about the market, what you try to do is you try to take chaos theory, for any of you that have studied chaos theory, and we all know a little bit about chaos theory by the butterfly effect, right? Have everybody heard of the butterfly effect? Right? Where, a butterfly flaps its wings in Brazil and causes a tornado in Texas. And I find that Mandelbrot, yeah. I find that really, really fascinating because um, because that's what the markets are too. Um, for a long time, I traded some of the indexes, and in the bigger indexes, there's a real game going on between some of the largest institutional traders out there. And for example, sometimes when you approach a support and resistance area that a lot of institutional traders know about, what happens is that there are traders on one side and traders on the other side, and sometimes just that one trader, that one large institutional trader, a retail trader can't do it, but that one large institutional trader that pushes that market too far past a certain level ends up setting the tone for the whole day. Isn't that really cool? Where the market really doesn't have an idea what it's going to do the next day, but based upon the players that are involved in the market on any one given day, one institution can kick off a trend day. Another institution can kick off, and when I say institution, I mean anybody that's trading size, okay? And I'm not just talking about order fills, okay? And that's what the whole topic, the whole point of this lecture is going to be. What's the difference between regular market dynamics that happen each and every day versus the games that are played in the market, okay? And this is kind of the point of this entire lecture. So I'm gonna kind of really talk about that in depth, because I think you have to understand the differences, right? You have to understand the differences. So does everybody kind of get what I'm going at? Where one person, one large trader, now it can be an individual, it can be a hedge fund, it could be a bank, it could be whatever, okay? So a lot of people like to say the hedge funds, the banks, the institutions. I know one guy that throws around literally 10,000 contracts on the ES. That's a lot. And he can do that in one order, right? So that's one guy, one person that can do that, right? So my point that I'm trying to make is that when you think of the markets, the way that the majority of the institutions trade the markets is, and we'll get to this. Let me just do the disclaimer here first, guys. I get this disclaimer out of the way. Anything I say, don't listen to me. Listen to a licensed individual. Everything that I'm talking about is just my opinion, and it just has to do with my beliefs and understanding of the 27 years that I've been in the market. But this is in no means professional or investment advice of any kind, yada, yada, yada. So just get that out of the way. Okay. I'll just quickly, I'll get through this because I want to get through the first couple of slides. 27 years of experience, individual retail trader, trade my own account, private coaching, blah, blah, blah. And let me get to the slide. So what I'm trying to get at is I'm trying to get at a point, because a lot of people, since I started my first webinar, email me, they Skype me, and they say things like, like, what do you think of this liquidity run? What do you think of that liquidity run? And for those of you who haven't watched my first webinar called The Big Boys, I talked about liquidity runs, and I talked about how they happen. But one of the problems after I did that webinar, and one of the problems people have with liquidity runs is they think that liquidity runs happen all the time. I think whenever a market moves, it's a liquidity run. Well, that's just not the case. All right. As a matter of fact, liquidity runs are just a very small portion of what actually happens by large institutions. All right. So one of the things I really want you to see if you can wrap your mind around is that although the market is quote unquote rigged, where large institutional players can and do, large traders, let me just put it like that, can and do move the markets from time to time, they don't always do it. Okay? They don't always do it. And they do it some of the time when the circumstances are favorable. So what's a favorable circumstance? What would be a favorable circumstance? And I'll get to some of those examples in a bit, because I just want you guys to understand that, you know, there isn't always a game being played. There are, the majority of the time, there is normal supply and demand dynamics that are going on. However, there are times when the large institutions do move the market. So that goes to my next slide here. Like I said, each day, billions of dollars are put to work in the currency markets. And the largest percentage of those are just transactions that are happening from regular corporate orders and regular order filling. And those are hedging and various companies around the world that are basically just doing business, right? They're just doing business, and they're just locking in their profits. They're manufacturing. They're doing their regular everyday in and out thing, and that really is what takes up a big chunk of the orders that are happening in the Forex markets. Okay, so what happens when Toyota gets a very large order and they want to hedge that order against you know, a movement on the yen or the euro, let's just say, right? Well, they get that order and they say, okay, well, you know, we're going to manufacture X number of cars. Let's just say the number is $1 billion worth of cars this quarter, and they get that order and they give that order to various companies they deal with to go in and hedge that order against the yen or the euro, whatever the order is. And so because they can't plop that type of money down in the market, they give instructions on how they want that order to be spread out based upon the dynamics of whatever condition they're trying to protect, just in their regular business, right? So as that order is given to an order desk, the order desk then goes and facilitates that order at various prices. Okay, so that's normal each and every day business, which I would say is about, like I said, you know, on any given day, I would say the average of that is, you know, I'd say 65 to 70% of normal transactions. Then you got a bunch of retail traders out there that are also moving the market around by their various price levels that they're trading around of technical signals and stuff like that. And then you have the people that I'm talking about that do the liquidity runs, and that I call the big boys, if you will. And there's this big difference between Toyota and you know, what I would call a speculative hedge fund that's trying to make money. Okay? And so what do those speculative hedge funds do? Well, I'm speaking firsthand when I tell you that they develop methods where they are trading the very logical edges that they have. Okay? And they all have various logical edges that they have tested out and they trade around. And so that's one type of big boy. Okay, there's several types of big boys. Like I said, the large institution. The other type of big boy is like a quant firm or somebody that is trading some type of specific edge that they're working on, right? And I won't get into the exact edges that they use. Okay. However, there are other large traders that do the liquidity runs that I want you to understand that happen, but don't happen all the time. So I'm going to kind of pump up some charts here in a second and just give you an idea of, what is a liquidity run, when does it happen, and what's the difference between liquidity run and regular supply and demand. Okay? And so this is really the heart of the market. Okay, this is the heartbeat, this is the lifeblood of why price moves. Okay? And that's really important, I think, to understand it. Anyways, getting back to the story about this particular hedge fund that offered me a position, they were saying, we'll take your method and your signal, and we'll automate your signal, and then the computer will take out all the emotion of it. Well, it's funny because I think that's really, obviously these hedge funds, some of them are really great. This particular one does well over 100% a year plus. And I think that's awesome that you can do that. But I think that's just one way to look at the market. And, I've always kind of, no, it's actually in Chicago. But I've always viewed the market from a very different perspective. I've viewed the market as a live, living, breathing thing, which is what chaos theory and game theory is all about. So I'm rambling here because it's important that you understand if what kind of trader you want to be, because there are several ways to be a trader where you can like code things up, and you can just automate something and then have that emotion taken out of your decisions. And that's a great way to do it. You can make some good money doing that, but you also have to understand that you're going to be tweaking that method all the time. Okay? You're constantly going to be tweaking that method because the markets are going to be changing, and you're going to have to adapt to it. Now, some computer guys are really, really good at creating artificial intelligence, so they can actually make the market think a little bit, right? In this particular company that I was dealing with, one of the guys there was like this absolute genius. I won't say any names or anything like that, but let's just say one of the guys was responsible for a lot of the space programs that were going on. A real super genius guy. And so in this particular case, this company was able to kind of code logic so that the computer had some type of artificial intelligence, which I think when that happens, look out, because then some funds are going to do really, really well. But getting back to the players here, and getting back to how do we make money, okay? Now I'm going to quote one of my students this morning, and I'm going to actually tell you what he actually wrote to me in Skype. And this is something that I think is really interesting. It's important that you guys understand that. And I'm going to actually quote him. He said, Steve got stopped out again by the spread between the bid and ask. Chart shows yada yada yada, but must be the bid price. Steve, I have no idea what the hell is going on this morning. There seems to be little sentiment either way, one way or the other. The euro bottomed out at 6 a.m., tried to run up to where I had 5-minute sentiment, failed there and reversed. Now what? Okay. Um, and so my answer to, that's one of my actual clients, my answer to him was now nothing. And I said, congratulations, you have now realized that, you know, that 60% of the time nothing is going on that you can exploit. Okay, so I answered him, you're going to do nothing, and you're only going to trade when you know what you're doing, right? So I want to kind of get that. I'll get to those charts examples. Yes, I will, Alex. I promise. I want to kind of get to that now. Okay. So when is there a random market that is just noise, that we call it, and when are institutional players playing? Okay, that's what your goal should be as a trader. So I'm going to now turn my slide on to some charts. Okay. It's important you guys get the theory right, okay? And I'm not going anywhere, Alex. Don't worry. I'll be back for many more seminars, hopefully. So please understand, this isn't something that that we're trying to learn everything today, okay? It ain't going to happen, guys. You're not going to learn everything in somebody's 45-minute seminar. Okay, can you guys see my Euro 5-minute here? Let's make sure you see my Euro 5-minute. Okay, very good. All right. All right. Now, on this Euro chart, coming into today, one of the things that I was looking at was, you know, is there noise going on, or what kind of traders are participating in this market? Okay, are there large traders that are moving the market directionally, that are all in sync? Is it a bunch of random retail traders that are moving the market around today? Is it one big player that might be moving in the market around today? And so that's kind of what, you know, the thought process is that I look at the markets from. Okay, I want to know, you know, who's involved in this market. Now, let me tell you what I'm talking, to show you some differences here. Here's daily Euro. Second, guys, I just have to get this off. Here's a daily Euro, okay? Now, after a day that is very one-directional, okay? It's very one-directional day. One of the things you would know after a very one-directional day is that this was pretty much the synchronization. If we take this day here, okay, for example, this was the synchronization of basically all worlds. You had the retail traders probably getting their ass handed to them. You had the large, you had the corporations, you had the banks, you had the speculators, and you had all the big boys all in sync here. Okay, on a day like this is where all the big boys were doing the same thing at the same time, and the market was being moved, and that's why that move happened. Okay? So on a day like this particular candle here, okay, a day like this was synchronization of the large players. Okay, are we clear on that? Okay. What about a day like this one right here? Okay. A day like this there was indecision between the large players, and to a point where they all decided it's now a good deal. Okay? It's now a good deal, and they all agreed at this particular point in time on what the market should do. Okay? And everybody agreed at this particular point in time the market was a good value at this level, and therefore we should all participate in this move. Okay? So whenever you look at a chart, rather than looking at a chart and saying, I got to watch the 1 hour here, guys. I got a trade on. I apologize for those of you that don't know me right now. I do trade full time for a living, so I have to manage my trades sometimes during these webinars. I apologize if it distracts me from the thought process. But like I said, I'll be back for many more webinars in the future. Now, this is something that this is where, by the way, this is a great example right here, because this was just liquidity happening right now. Okay, I'm going to exit my trade here. Hope you guys don't mind. Going to exit my trade. All right, buy market. Done. Oh shoot! Oh damn it! Sorry guys. I just mismanaged that trade. I just closed this. My bad. Sorry. Very sorry. My apologies. This was a situation where I was not trading a liquidity run. Okay? This was a situation where I was just trading off of regular supply and demand. All right? Very different situation than this trade over here, which I believe was a liquidity run. Okay? I believe this was a liquidity run. Let me just get this Skype room up here. Okay. Okay. So, thank you. I'm glad I entertained you guys. Okay. I'm glad I entertained. Dark Star, how you doing, buddy? Wow. Good to see you in the room, pal. Dark Star's a great guy, by the way. Anyway, so I want you guys to know the difference between the two, okay? There's a massive difference between, Dark Star, by the way, talks about liquidity a lot. He's a great guy. And I don't think I can plug you here, Dark Star. I don't think it's allowed, but for those of you that don't know him, you can PM. He's a great guy, great trader. So what's the difference, okay? This particular move that I was trading, that I just exited out of this thing, was not a liquidity run, in my opinion. Okay, maybe the last little bit of it was, okay? Maybe the last 5-10 minutes of this were some very large traders coming into the market and moving it down to go and grab some orders down here. But in my opinion, this was just normal supply and demand, okay, on this particular move. All right, and so that's the whole topic of this webinar, is what's the difference, right? What is the difference? Okay, who are the players? How do they play? When do they play? And why do they play? Okay, so it's important that you know that, because the way that price moves will give you a lot of hints and indication as to how you should play the market. That particular short that I just took off there was one that I was sitting in from yesterday afternoon. Okay, I got in somewhere around here, I believe. Okay, and I sat in that trade. I took a lot of heat on that trade, and then ultimately normal supply and demand came down and took out and had this move lower. Okay, so let's try to see if we can find some differences between normal market behavior, which is supply and demand, and what one of the tools that what do you call it, that institutions use, and that's the liquidity runs now. So for example, this particular move here, we see up here, this to me is very, very obvious. Okay, now people say to me, well, how do I know before the fact something's going to happen? right? Everybody says to me, how do you know before the fact that something is going to happen? You don't. I wish I had a way of knowing. And there are people that watch level 2 screens. And when I traded stocks for a long time, you could get a really good idea of institutional buying and selling by watching level 2 screens, right? But when we trade the Forex markets, we don't have that same type of luxury of being able to watch a level 2 screen and be able to judge the buying or selling pressure of any particular market move. So a lot of the times you're left guessing, okay? A lot of times you're left guessing whether or not something is going to be a liquidity run or not. So how do we exploit that, right? We exploit that by basically, I feel more like adding to a position, right? Rather than saying right from the beginning that something is going to happen. Like, so for example, when the market had this down move here on this 1 hour chart, if I was participating in this trade here, and then I believed that the market was going to go lower, and I would have gotten into a trade off of a 1 hour chart, and then I would have been watching the live market. Oh, I got a message here. Okay. If I would have been watching the live market, then I could have added to this trade as we came into an area where there was going to be a lot of orders. Okay. Now, could I have known up here at this level that a run was going to take place? No, there's no way I could have known that. Okay, there's no way I could have really known that. I'm basically guessing at that point in time. Okay, but when this move happened, I do know after the fact that was in a large part all the institutions were lined up, and remember I said earlier that if you ever traded the ES, you can have one institution kick off that butterfly effect, or that domino effect actually is more what it's like. You got a domino effect that actually happens, right? And it's that one institution that will kick off that butterfly effect, and then what will happen is then then a liquidity run will happen. So when I see this type of action take place, I know what's going on. Okay? I know that is not just an institutional buying and selling, and not just supply and demand, but I know at the end of that happening, I know that is basically the games being played in the market, if you will, okay? And so again, I think it's important that you understand that that's the way what's going on is normal market behavior, okay? So this to me would be a liquidity run, okay? And then when the market rallied back up here and then started to mess around here, normal supply and demand comes back into the market. Okay, this is just normal supply and demand, which is a combination of everything. That's a combination of retail traders, it's a combination of institutions, it's a combination of speculative traders. And then as the market begins to move back down again, okay, then we start to see more speculative action come into the market where orders are starting to be gobbled up and targets are being made. But this is really kind of different. This move is really kind of different than this move. Okay, this move right here looks to me directly like there is particularly large, maybe 2, maybe 3 or 4 large players that are moving the market down at this particular move. This move looks different because of the sustainability of this move to me. Meaning that because the market not only went down and got probably an accumulation of orders down here, okay, but the sustainability of this move was a little bit more. So this was a combination of liquidity runs by large speculators and a combination of regular supply and demand. Okay? And again, let me see if I can find another example. This is just recent thing. This move right here looks to me like it would be both, again, a combination of liquidity runs and a combination of regular supply and demand. This move right here, trust me when I tell you, except for maybe the last 15, 20 pips of this, okay, was nothing but pure supply and demand. Hey, you guys like my exit here? Huh. Look pretty smart now, don't I? Anyways, so this move right here is regular supply and demand. Now I'm being proven right here because, as you can see here, the market bounced. Now, probably if I was able to focus, I probably would have faded this particular move and looked for a move back up to the upside, because I do believe once we hit this level, we're probably going to go back up. And now I believe as we approach into this level, I believe you may see some different price action happening. I believe what you will begin to see at this particular level is you will see in this area right here, there's a lot of games going on that are kind of weighing the balance. Okay, so getting back to that story about the various hedge funds, the large company that offered me billion-dollar hedge fund that offered me a deal, they have actually a few systems, but a lot of the high frequency stuff that takes place is what's also affecting a lot of the markets that we see right now. So how do you tell the difference, right? How do you tell the difference? Well, like I said, you can't really tell the difference until after it is happening. But what you can do is you can get on the right side of the market, and you can always put those odds in your favor, okay? And so, for example, this trade that I took a lot of the heat on yesterday, I didn't mind taking more heat on it because I knew I was on the right side of the market. And I knew that maybe in the last 20 pips of this, a liquidity run might happen by some very large speculative players and some high frequency hedge funds, right? I knew that might happen, but I knew that it didn't happen here. It didn't start here. It didn't start here. It didn't start here. It really didn't start until we got to a level where the difference between this point and this point, the math added up. Okay? Because in order for an institution to make money, the math has to be there. Again, talking about my buddy Darkstar, who's a mathematician, right? Or very good with math. He'll tell you that the math is very, very important, okay? Meaning that in order for an institution to make money, if they're basically investing, $10 million or $20 or $30 million to move the market 20 pips, if they're investing $30 million to move the market 25 pips, there better be $32 million worth of profit down here, right? Because they're not going to do it unless they're not going to invest that $30 million to move the market down to this level unless there's, I'm saying $31 million worth of profit down there. Does that make sense to you? Right? So the math has to be there. All right? I'm going to try to answer some questions because I only got 5 minutes left here. Like I said, for those of you that don't know me, don't worry about learning everything today. I'll be back next week, same time, same bat station, same bat channel. Okay, some questions. Virginia or Georgia, Virginia, Steve, what's the difference? What differentiates the initial down move versus the liquidity run? Once again, George, I think I answered that. Meaning that if you're on the right side of the market, a lot of the times you're going to be able to participate in the liquidity run. So what's even more important is just making sure you understand regular supply and demand dynamics and staying on the right side of the market. Okay? And in some of my other webinars, I talk about how to stay on the other side of the market. I did a webinar, unfortunately, that wasn't recorded. Maybe I'll do it again, which basically keeps me on the right side of the market every day. Okay, and that's just basically following London and following Asia. Okay, let me get to some other questions here. Alon, in your example, the liquidity run is initial bearish sentiment in the marketplace. Alon, sentiment does play a big role in that as well too. And again, referring to my buddy Darkstar here, actually, I did learn. One of the things I did learn from my friend Darkstar is a great way to look at sentiment. Okay, so sentiment is also important, but it isn't everything in my opinion. Okay, sentiment plays another FX Street analyst, Jamie. Shoot, I can't remember his last name. He wrote a really good book on sentiment. Does anybody know his name? Jamie? Shoot, I have his book. I read his book. It's a great book on sentiment. Yes, Jamie Seattle. I can't pronounce his name correctly. He wrote a really good book on sentiment. So sentiment does play an important part in keeping you on the right side of the market, right? Let me get to some other questions here. Are you saying large candles mean big boys campaign? So Trader Daily says to me, are you saying large candles mean big boy campaign? Can it happen because one side of supply and demand is a lot more? Trader Daily, it's a combination, okay? So what we're trying to do as traders is we're trying to be in sync with everyone, okay? We're trying to be in sync with everyone. Does that make sense? Right? That's my goal. When I wake up every day, I want to try to be in sync with everybody. So I want, as I talked about in some of my other slides here, let me just close this off. I talked about some of my other slides here. I want to be in sync with Toyota as much as I want to be in sync with the speculative money that's moving the market, and hopefully even the retail guy. Okay? Right? Some other questions here. Let's see here. Getting on the right side of the market is easier said than done. Alon, yes, it is easier said than done, but it's not that easy, okay? It's not that hard. It's actually very, very simple. I could teach a 12-year-old to stay on the right side of the market. Soros asks, do we have to browse which time frames can see the price liquidity happen? Excellent question. I want to talk about that. Maud, do I have an extra 5 minutes? Because Soros brought up an excellent question. I want to talk about that. Do I have an extra 5 minutes to talk about Soros' question? Okay, hopefully I do. Otherwise, I'll have to leave. Okay. Soros' question, do we have to browse time frames to see which price action liquidity had? Yes. Okay. Yes, Soros. Here's what you got to do. When I wake up in the morning, I want to trade whatever time frame looks good to me. So if I'm looking at a 1 minute chart, if I see something that's exploitable on a 1 minute chart, I'll trade a 1 minute chart. If I go to a 5 minute chart and I see a mess, I don't want to stay on a 5 minute chart. Why the heck would I want to stay on a 5 minute chart when it's a big mess? Right? If I go to a 15 minute chart and I see something that looks exploitable, I'll trade off of that 15 minute chart. So this is excellent. Sorry guys, let me get my thing back over here. Let me just show you what I'm talking about. If I go to a 1 minute chart and I see something that's exploitable on a 1 minute chart, again, take advantage of it. If it's making sense to you, whatever your style of trading is, trade off of that 1 minute. Like, let me ask you a question. You're think of yourself as a janitor in a casino. Don't know why I thought about that, but it's a funny analogy because it's a true story. It happened to me the other day. I actually saw the guy that sweeps up the floor in the casino pick up a $25 chip. Okay, so as a trader, oh, somebody's PMing me. 5 minutes left, no problem, Maud. As a trader, if I'm the janitor and I'm on a 1 minute chart and I see a $10 trade on my style of trading, should I take it? You're darn right I should, right? Because it's $10. And if I see a $25 trade on a 5 minute chart, should I take it? Absolutely. It's $25, right? And if I see a $100 trade on a 15 minute chart, should I take it? Absolutely, because it's $100. And in my particular case, on this particular trade where you guys just saw, I don't know if you saw my P&L, but I think I made around $1,400 or $1,300 on this trade. Should I take a $1,300 trade? You're darn right I should, because I was on 1 hour chart. But my point being, and Soros' question is excellent, right? Trade where you see whatever it is your edge is that you're trying to exploit. Okay? But getting back to the topic of, the big boys, I want you to get it through your mind, if you can, that there are constant dynamics that are taking place. Looking at this 1 minute chart tells me a really interesting story. See this move that happened from here to here? Okay. My guess, and I don't know because I don't know what the answer is, my guess is this 20 pip move looks like a liquidity run. Okay? That's what that looks like to me. Because the dynamics of this move and this move and this move and this move down here, okay, that to me looks like a liquidity run. Okay? So is it necessarily just a large candle? Somebody asked me earlier, is it a large candle? It's not necessarily a large candle. Okay? It's not necessarily a large candle. It's how that candle moves in context of everything else. And for those of you that haven't watched my video on context, go and watch my video on context. Anyways, I think that's going to wrap it up for me. Skype me if you want. Any questions you want, give me a call. As long as I'm not in the trade, I don't mind talking to everybody. I hope that was informative. I'll be back. Same bat channel, same bat station. Geez, I'm showing my age here. And I hope you guys enjoyed it. And I guess bye for now. Thanks, Maud. Thanks, Vicky. See you, Darkstar.